Howdy, Jacob here. Today we're looking at Cognizant Technology Solutions Corporation in the IT services industry. 37.7 billion market cap on 36 billion enterprise value. Growth of revenue has been a little bit less than double. Still looking at 6 to 8% year-over-year revenue growth on average. Pretty impressive. It has dampened down the last 5 years. The beginning of the last 10 years was definitely more substantial, but I still think that there's still some growth here. Gross margin down, operating margin down. I don't like that. And they're starting to pay a dividend. It's not substantial in relation to earnings per share, but still taking away from more heavy possible growth, which is this return on invested capital in the mid-teens. That's impressive. Cash flow has their use of cash, mostly share repurchases and a dividend. That's going to be almost entirely their capital allocation, with a tiny bit going to debt reduction and a tiny bit going to acquisitions and reinvestments. Balance sheet has 2.6 billion cash-like products with 33 million short-term debt, 606 million long-term debt. Again, a good balance sheet company. Cash flow production has about the same increase in cash from operations as capital expenditures from a percentage standpoint, but that means the free cash flow is still much higher. And again, use of share repurchases and a dividend. I think we're ready to make some assumptions here. So that dividend, historically, they've increased at least the last 5 years pretty consistently. And the payout is currently maybe 25%. So I do think they can increase that with their revenue growth, and revenue growth organically, a little bit of reinvestment, a little bit of acquisition, probably only 20% allocation for that. They can probably go 6% a year. So let me keep that allocation the same, since that's kind of what they've done historically. For margins, pretty consistent. Let's do 11, 12. Share change, 1% for them is about $380 million. 380, 760, offset stock-based compensation, a little over 900. Okay, so 2% is going to be pushing about 50% of capital allocation, but I'm fine with that because we have about 25% to dividend, 20% to acquisition, reinvestments, and then 50% to share repurchases, leaving about 5-10% for debt reduction. I think I'm fine with that. Maybe I'm underselling one of these, but I do think I'm definitely comfortable with that estimation. Terminal PE, they do have a high return on invested capital, but again, they're not reinvesting it. If you have a great return on invested capital and all you're doing is buying back shares and giving money back to the shareholders through a dividend, to me, you deserve a tiny bit of premium because you have the possibility of getting high rates of return on the money reinvested in the business. But if you're not actually reinvesting anything, that takes away the premium for me. And so to me, I do think they'll have growth pretty much in line with market, with a return on invested capital higher, but they've just historically bought back shares and paid a dividend. And so with them, probably just a 17 PE for me. And honestly, 28% before we get to return we're looking for here. We're pretty close. So interesting company. Hopefully it drops like fire and I do some research on it. But either way, I do hope you enjoy the video and have a great rest of your day. Thanks.